Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal, and in today's episode we'll talk about 4 big stories. First, we'll talk about interesting trends from the quarterly results of Reliance. Second, even HDFC Bank released their quarterly results recently. We'll talk about some interesting trends there as well. Third, we'll talk about expectations from today's budget announcement. And fourth, finally, we'll talk about how Amazon is interested in buying Swiggy's Instamart business. So let's begin with our first story. See, Reliance recently released their quarterly results. Now, I'm sure you already know Reliance is one of India's biggest conglomerates. As we've discussed in some previous episodes, they are just about everywhere, from oil to chemicals to retail, and they are also aggressively entering new categories every single day. And if you remember the discussions from our previous episodes, Reliance is also partnering up with Shein for cheap fast fashion and is also looking to compete against Decathlon. They are also getting into the quick commerce vertical to take on the likes of Zepto, Blinkit, etc. Now, talking about the results, Reliance had a bit of a mixed quarter. See, although the overall revenues went up by about 12% to 2.36 lakh crore rupees, its profits dropped by 20% compared to last quarter. Now, this is largely because of their oil to chemical segment, which makes up almost about half of their revenues. But let's not focus on just the quarterly numbers because the news outlets do quite a good job at that. Instead, let's look at some interesting and long-term trends that have emerged from this quarterly results report by Reliance. First, they are now the biggest retailer in India. They are even bigger than D-Mart. This quarter, they added about 331 new stores, which brought their total to about 19,000 stores. Second, digital and new commerce now makes up about 18% of their total revenues. JioMart, which is their e-commerce platform, has really taken off as well. It is now available in 180 plus cities. Third, they are even getting into slow commerce. They promise 30 to 60 minute deliveries now. Fourth, Reliance Retail has also been on a shopping spree lately. They have bought stakes in companies like Zivame and Urban Ladder. Fifth, Reliance Retail's growth is fueled by the grocery and electronics segments. On the other hand, fashion and lifestyle segments have not really done too well. However, one thing to note here is that there were many discounts and promotional activities on electronics, while the decline in fashion and lifestyle segment might have been due to a decline in discretionary spending. Now, despite this, Reliance Retail is very focused on refreshing its offerings and launching new store formats. As we discussed in some of the previous episodes as well, there is also a premiumization trend that is playing out. Reliance is also playing along with this premiumization trend by offering premium things like Pret-a Manger and Ajio Luxe. Now let's talk about Reliance Jio, which is India's largest telecom operator. First, they added 8 million new subscribers in this quarter, which brought their total to about 480 million people. Second, their average revenue per user or ARPU stayed flat at 181.7 rupees, but they've recently hiked their tariffs by 12 to 25%, so this number might really go up soon. Third, 5G now accounts for 31% of Jio's mobile data traffic. Jio, by the way, has one of the largest 5G subscriber bases globally. Fourth, Jio is planning to invest $10 billion over the next 3 years to roll out 5G across India. Fifth, Jio Fiber is growing very well as well. With over 1.1 million home connections this quarter, the growth is really crazy. Now moving on, let's talk about HDFC Bank. See, if you've been following this podcast, you probably know that we've spoken a lot about inflation and credit growth. In today's story, we are also going to focus on credit growth again. So let's talk about some of the very interesting trends that are visible from HDFC Bank's latest quarterly report. Let me break it down for you. First, one of the key metrics to look at in banking is net interest margins. It is basically the difference between what a bank earns from loans and what it pays to depositors. It is expressed as a percentage of the bank's total assets. For HDFC, this metric improved a little bit from 3.4% to 3.47%. Second, overall the numbers are moderate, but HDFC's MD and CEO Shashi Jagan said something very interesting in their quarterly call. He said, and I quote,
I have mentioned in the annual report recently, which is released to the world at large, that we will be growing slower in our advances as against our deposit growth. This is not something new. If you've seen our track record over a long period of time, this is something that has been there.
Now, what does this mean? See, HDFC Bank is choosing to grow loans more slowly than its deposit. This is because post-merger, their loans have grown faster than deposits. And by slowing down growth, they can reduce their credit to deposit ratio, which can make the bank more stable. Now let's zoom out a little bit. Remember we discussed credit growth in one of our previous episodes? In case you missed it, let's play it back for you. But first, for context, credit growth data shows how people are borrowing and how banks are lending. Now before we get into the details of this, let me give you some background. See, before the pandemic hit, credit growth was pretty much very weak. In simple words, banks weren't quite lending too much. But post the pandemic, credit growth has been spectacular, especially in personal loans and in credit cards. RBI's latest data reveals some very interesting insights. Overall credit growth is at 16% year on year. For comparison, it was just 6% in July 2021. This shows the total money lent by banks across all categories. But after hitting a peak in December 2023, it has been pretty flat. Second, personal loans are growing at about 18% year on year. But there is something interesting happening here. In November 2023, the RBI increased the risk weight for unsecured personal loans and credit cards. This means banks had to set aside more money for every rupee they lend in these categories. The RBI Governor Shashikanta Das recently said something very interesting at a conference. He said,
"Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks. On their part, banks have sought to fill the credit deposit gap by increasing their reliance on other sources like short-term borrowings, certificates of deposit, etc. This increases their sensitivity to interest rate movements and poses challenges to liquidity management."
But Deepak Shenoy of Capital Mind pointed out something very interesting in the RBI governor's comment. He tweeted, "All money in mutual funds eventually comes back to the banks. Worldwide, money market funds have more money than bank deposits." RBI governor is saying that we be ready for lower CASA, not fearing for bank liquidity. Now, but then why is the governor saying what he is? See, in a recent interview, he said that he was worried about credit growth being much higher than deposit growth. Although it is okay for credit growth to be higher than deposit growth, he said that the gap between these two have to be reasonable. The RBI has also been indirectly nudging banks to fix this imbalance. Now moving on, let's talk about whether the budget will really fill your pockets this time or will break your heart. See, the Finance Minister Nirmala Sitharaman is all set to present the Union budget today on 23rd of July. Let's take a look at the different kinds of expectations that people have from this year's budget. Let's go sector-wise. First, infrastructure and social welfare. See, experts believe that the government is going to double down on these. We might see more money pumped into green and sustainable energy projects, which is because fighting climate change is a capital-intensive activity and our investments so far have been lower than what is required. In fact, even foreign capital has been in the form of loans and not really grants. Next, we might see a boost in spending on infrastructure for education across the country, especially digital resources for rural India, which will be in the line of the educational policy of 2020. Next, we might see increased allocation for affordable housing under the Pradhan Mantri Awas Yojana scheme. And the hope is also to see more funds for agriculture infrastructure and a push for farm tourism to boost rural incomes. Now, all of this is important because the government wants to focus on economic growth and development. Big infrastructure investments are key to driving long-term growth for the country, and these investments will help us reach there. Now, of course, this is the most awaited and the most talked about part of a budget because it directly impacts the pocket of a common person. This time around, there is a lot of hope for some tax relief, especially for the middle class. The hope is that the government will increase the tax-free limit to 5 lakh rupees instead of the previous 3 lakh rupees and introduce some more tax incentives for home loan borrowers and real estate developers. Now, there might not be any major tax rate cuts though. The government is focused on fiscal consolidation, which in simple words means increasing revenues and decreasing expenditures in order to boost growth. Third, let's look at some sector-specific expectations where we'll talk about solar, insurance, and the education sector. So let's start with the solar industry. First, there is hope for income tax benefits for those people who adopt solar power at their residences. Next, there is also hope that the government will announce a tax holiday for companies that invest in solar cell or module productions. Now moving on to the insurance sector, there is some hope that the government will reduce GST on some insurance products. Moving on to education and skilling, there is a big push this year for enhancing STEM or science, technology, engineering and management education this year, as well as expanding digital infrastructure in rural parts of the country. There's also hope that the government will allocate a larger part of the GDP to education than the previous 3%. Moving on, we'll talk about fiscal management and tax reforms. See, this is crucial because this is the government's first budget. They'll need to balance economic priorities with fiscal discipline. The expectation here is that there will be a commitment to bring the fiscal deficit down to 4.5% by FY 2026. There is also hope for a new direct tax code to simplify the tax structure and some tweaks to the GST law to increase compliance. Moving on, there is also hope for an announcement on the change in PSU divestment plans. See, as we discussed in some of our previous episodes, the government has been trying to sell PSUs for many years now, but it has consistently missed its targets for the last 5 years. The expectation this year is that the government will keep PSU divestment targets at 50,000 crore rupees. But the government might also be changing its strategy a little bit. If news reports are to be believed, instead of selling PSUs, the governments may now try to make them more profitable. It plans to set 5-year performance goals for PSUs and invest in training their managers. Finally, we look at expectations from the mutual funds industry. The Association of Mutual Funds in India, or AMFI, has some very interesting hopes for this budget. First, they want pension-focused mutual funds to get the same tax benefits as the National Pension Scheme. Second, they are pushing for changes in how debt mutual funds are taxed. The proposal is a 10% tax rate on long-term capital gains without indexation. Third, they proposed a new debt-linked savings scheme which is similar to ELSS in order to encourage retail bond investments. So all in all, in summary, the government is trying to balance many different priorities at once. It wants to boost growth, but it also needs to keep the fiscal deficit in check. It also wants to attract investments, but it is also rethinking its approach towards PSUs. Now there is also the fact that this is the coalition government, so it will be very interesting to see how the government really maintains all this balance. I would love to know your thoughts in the comments. Now let's move on to the last story for the day. According to recent news, Amazon seems to be very interested in acquiring Swiggy's Instamart business. According to some news sources, Amazon India has approached Swiggy to discuss this deal. Amazon is looking at two options. First is acquiring a stake in Instamart during Swiggy's upcoming IPO, and the second one is buying out their entire Instamart business. Now full disclosure here, these are just reports which say that the talks are still in very early stages and no official offer has been made yet. But see, if this does happen, it is going to be a really big deal. Here we are talking about the acquisition of one of the largest quick commerce players in India. Now the benefit here for Amazon is pretty obvious. They get a very strong entry into the red hot quick commerce market without getting into the hassle of building it from scratch. But for Swiggy, I'm sure you're wondering what the benefit really is, especially since the quick commerce future seems to be so bright today. Now look, for all you know, Swiggy might not really be interested to sell. I'll remind you that this information is still unofficial right now. But in case this story does play out and Swiggy does decide to say a yes, there are a few reasons why I think they could justify it. First, this deal could help Swiggy focus more on its core food delivery business. For investors who are bullish on food delivery but not so much on quick commerce, this could give them a lot of confidence in the Swiggy brand. Second, it could avoid cash burn for Swiggy in a very competitive environment of quick commerce. Now, because of heavy competition in the quick commerce space, companies need to keep spending a lot of money in order to capture more market share. Letting go of Instamart could really save the IPO-bound Swiggy a lot of cash burn, and this could help them become profitable much sooner. By the way, as on date, no quick commerce model around the world has become profitable yet. The third thing they could do to justify their sale is that selling to Amazon could also help Swiggy form more strategic partnerships with a global giant, which could mean a much bigger and wider distribution for them. Now this has a lot of meaning right now because Swiggy has recently filed its papers with SEBI for a $1.25 billion IPO. And if this deal does go through, it could really impact Swiggy's IPO plans in many ways. It'll be very interesting to see what happens if this deal actually goes through. We are talking about a deal between the biggest e-commerce giant in the world and one of the biggest food delivery and quick commerce players in India. If this deal happens, it'll also be very interesting to see Zomato and Swiggy going in opposite directions for the first time. For your context, Zomato is betting very heavily on quick commerce with Blinkit. Zomato CEO Dipinder Goyal also recently spoke about how food delivery is getting saturated and how Blinkit is going to become much bigger than the food delivery business of Zomato soon. Also, Goldman Sachs recently estimated Blinkit's value to be more than that of its parent company Zomato. There's a lot that could happen here in this story, and I'll be sure to cover it as and when more things unfold. Well, that's all the news I have for you today. I hope you found value in this. I'll see you in tomorrow's episode. Take care and goodbye.